This podcast is brought to you by the Resolve Long Horizon Investing Masterclass, a 10-part evergreen podcast series where Adam Butler, Mike Philbrick, and Rodrigo Gordillo of Resolve Asset Management Global explore an advanced investment framework specifically designed to steward quasi-permanent capital with humility and balance. From the science of decision-making to all-weather portfolio construction to the value of diversified alpha and tail protection, this series provides a comprehensive capital management roadmap to improve outcomes for wealthy individuals, advisors, family offices, and institutions managing less than $10 billion. To listen to the series or read the transcripts on demand, please visit investresolve.com/masterclass. Alternatively, you can find it on your favorite podcast player by searching for Resolve-Masterclass.
All right.
Friday.
All right.
Happy Friday, everybody. Another week has gone by. And
I'm just
before we
retweeting this out for everybody to go live. Sorry, go for it.
Cheers to everybody. I'm doing Sober September, so I'm not drinking today, which is difficult to understand, but cheers. I don't like it anymore.
Salut.
Cheers.
A little Moscow Mule on my end.
Oh, nice. I love the mule.
Actually,
the
Vodka,
Moscow
diet
Mule,
tonic, and lime here.
Ooh.
Don't forget the zinc. You got to
You
gotta
got to put a
get
little
the zinc.
capsule of zinc in there. You get a little extra immunity protection. Jacks
you
up your
mean
immunity.
alcohol number 1, quinine number 2, and a little bit of zinc, a little zinc capsule.
I'm not sure.
It's a good start. It makes all three of
I'm
them.
not sure how they line out there in the priority, but they're all in the mixture. So
I love it. I love it. And just a reminder that the four scoundrels on this call are neither doctors nor providing any kind of investment advice of any kind.
or medical advice.
Yeah, or medical advice. Is purely for entertainment purposes only. You shouldn't be listening to four guys drinking on a Friday afternoon if you're looking for investment advice. Having said that, I think we got a pretty good guest today, guys.
Yeah, we do.
Extra
Pretty
special.
accomplished individual.
Yeah.
So where do we want to start? Tom, you want to just dive in and sort of start with your arc, the brief version, maybe?
You mean how I got from being born to where I am now?
Yeah, something like that. Going from
In
chapter
18
1,
seconds or
I
less.
was born.
Okay, well,
engineering
my
to
investment world
investing,
started when I was 12 years old delivering papers. And I made $10 a week, so I bought a mutual fund. It was a Fidelity mutual fund, actually. Front-end loaded, high cost, terrible investment. I learned a lot about markets going up and down. Went through 73, 74 bear market as the junior and senior years of college. So I got close up a view of a market going down nearly 50% on the S&P, I think. And so I got out in the real world as a chemical engineer. Some guys at the table for lunch said, hey, let's talk stocks. It's kind of fun. You could invest on the side and all. So I started doing that and started a stock account. That was successful. I eventually said, if the stock market goes down like it did in 73, 74, this is not going to be pretty. How about if I learn how to trade commodities? So I started doing that. Took 4 years for that to get to break even. Fifth year was profitable. That required a lot of patience and engineering background.
How did you get through that, patience?
Well,
just 4 years
one
of
thing
small
was
losses, learning. What was it?
It was small accounts, so small losses, almost by definition, because I didn't have a large account in those days. But what you ended up doing for me is I logged everything, being the good little engineer that I am. Log in, where you got out, your thoughts at the time, what indicators you used, try to learn from it. And I always called it, I just got through paying like $18,000 to get a chemical engineering degree. The College of Trading has tuition too, and I figured I was just paying some of it. And every year I got closer to break even, so that was also a positive trend. I was losing less, so that was good. And that kind of bought me the patience to just keep pursuing and keep figuring it out. And I always felt like I learned something and tried to improve, and I could see that it was helping, and it gave me the patience. And then from there, I started managing money on the side. I actually stayed as a chemical engineer, and there was friends that were asking me to manage their money, and you could do that back in the old days. I'm not sure it would ever happen today, but just the start in your basement story, and it gets to be big. And I finally do the math, and I said, hey, my two partners at the time, I said, if I calculate this out, I'm making this with benefits. If I look at what our fee schedule is and all that, we could pay me the same amount that I'm making now. I'll just go full time, and I'll raise enough money for you guys to join me. And that's what we did. And then
Can I back it up a little bit? Because I'm actually dying to know. So you've got a paper route, you're earning $10 a week. What triggered you to take that money and put it into a mutual? I mean, that would have been that would have been right around the time when mutual funds were just becoming, known, right? So
exactly.
How did that happen?
A salesman came by to try to sell my father, the postman, this load fund as his spiel of sales or whatever. My father listened. I decided, since I had some savings, that I would listen too. My father did not buy the mutual fund. I did.
Amazing. And that would have been, I mean, from 66 to 73 was a reasonably, good period in the market, right? So that would have been a time when everyone was feeling relatively optimistic about investing in stocks. And, and then you had the opportunity with, a very small amount very early on to learn this valuable lesson that markets don't always go up, which of course anyone who's invested in markets in the last 10 years has yet to discover, right?
These are gray hairs over here. What little there are of them.
The ones that are left.
The ones that are left. I've been through 73, 74. I've been through of course, the 87 crash. That was a fun day. And then we did I did the 2008 real estate debacle, the tech bursting bubble, went through COVID last year. So I've had a lot of pretty major bear markets that I've had to live through, and still trading.
As a manager of other people's money, in your experience, how valuable or how critically important is it to demonstrate an ability to successfully navigate those really acute types of crises, like the 1987 crash, for example? If you're successful in that, to what extent would that have defined a career and really accelerated the trajectory, do you think?
It accelerates it, but strangely, I would argue that if you want to raise a lot of money quickly, the hot track record always seems to draw all the flies. They're out of the woodwork at you, and you'll lose it just as quick as you go into your next bear market or next drawdown on your equity curve. If you want a business like mine that lasted 28 years, you have to be interesting enough to be interesting, but don't go beyond that, because you want to be as stable as you can possibly be. You sort of want to lull your clients to a comfort level that they're comfortable with, and as long as you're doing a positive return, a lot of times you tend to hold on to the assets. But you start, I don't care what clients tell you. They'll say, "Oh, I can take a 20% drawdown." Hell no, they can't take a 20% draw. At 7%, 8%, they're on the phone to you calling already and all nervous about what goes on. I sure don't miss that now in retirement. I don't miss it at all. For those, I get a lot of new traders coming to me and say, I've had a great 2-3 year track record, and I'm thinking going in the money management business, and I immediately try to talk them out of it.
Yeah. OPM and
other people's money.
Yeah, other people's money. It is.
Yeah.
The interesting thing about it that I've noticed over the years, and my first book was kind of an attempt to do something about that. It miserably failed, I think, but Panic Proof Investing was the goal of that book was to try to give it to a retail client in the effort that they could somehow learn more about being a good investor. Because in my opinion, the money manager is just an extension of what the investor, the investor is giving you the cash to manage or putting in an account, so you, with your power of attorney, to manage it. So you're in charge of that money. But the ultimate power lies with the client. They can always pull it from you at the worst of times. Right at a drawdown, they'll miss the next run up. You look at all these great money managers, including Trendstat. I've made equity highs many, many, many times. why would if clients had just stayed with that, they would have enjoyed that whole curve, but they never do. They come and go. And you sit there and you calculate what's called a dollar weighted return, which is the total dollars in versus the total dollars out. And these clients on average are losing money. And yet I'm by law presenting a time weighted return, which is required in my disclosure documents and all that. And I'm making new equity highs and doing just fine. And I'm one of my biggest clients at the end when I shut it down. And yet clients are coming and going, and I'm making new equity highs and they're losing money. And it's just because they give you money at the top of your equity curve and they take it out at the bottom, which is really ridiculous.
What's the Magellan Fund story again? In terms of money weighted rate of return? Was it the Magellan Fund? It was. I think, Mike, you've talked about this before, or maybe Adam has.
There's a few examples.
Oh, that's
exactly what
Magellan did. Exactly, they did a study of their investors, and that the actual investors had lost money, but Magellan was one of the top performing mutual funds over a 10-year period, and that was just in spades what I'm talking about. It's just kind of sad. So how do you get investors, to do a better job of giving their money to money managers? That's what I attempted to do with Panic Proof Investing. I don't know if people really read it and took it to heart, maybe it would help, but
I think Kahneman has taught us that even if you do know, you're still going to make the human mistakes, right? But I have an interesting observation when I look at trend followers, traders, and their track records all the way back to the 70s to now. Mm-hmm. And the observation is that back then, the volatility of their underlying strategies is running at 30 vol. And today we're running at an 8 vol. And I wonder if that is a learning from managing your own money, trying to get those high returns, high volatility, and over time realizing that people can't handle the volatility and start targeting lower volatility strategies because you're managing other people's money. Do you find, did you transition from taking more risk to less risk when managing people's money?
Absolutely. I never really was super high, but some of the early programs and futures, for instance, had plenty of sizzle when they wanted to sizzle. They were never going to be up there in the number one in the industry or anything in a good market. But there was times where I was pretty near the top in down markets where there was drawdowns going on in the industry, and I'm posting a positive return and there's other guys down 20. That I would attract a lot of attention then, but people didn't tend to pull the trigger still because I'm on a drawdown or I'm not. I've got a boring return. I mean, one of the reasons I almost didn't make it into New Market Wizards back in the day is Jack looked at my track record and said, I've looked at his track record. It's kind of boring. He wanted the sizzle to get the book, have a lot of flashy stories about traders that made gazillions of dollars. And my story from the outside looking in wasn't that compelling. But once he started talking to me, then he's, oh, wow, Tom's a little different from a lot of these other guys I've talked to. So it worked out in the end and it got in the book. But
it's an age-old challenge. As you say, you attract your attention when you're putting up massive numbers, when you're at the top of the boards in, absurdly short time frames, right? Mm-hmm. You had the best returns this quarter or, the best returns this month or something absolutely ludicrous in terms of any sort of signal to noise on whether you've got skill. So you've got this phenomenon where you need to stand out. The way that you typically stand out is by being at the top of the boards. But in order to be at the top of the boards, you've got to run hot. And by running hot, that also means that unless you've got an absurdly high Sharpe ratio, like a 3 or 4 Sharpe ratio, then you're also going to be at the bottom of the boards on occasion. And you're going to be in drawdown territory, which, as you say, is going to send many investors running for the hills at precisely the wrong time.
Exactly.
Right? In your 28 years of running OPM, did you come close to converging on a solution to that?
That was the book. I tried. The last solution that I did was an interesting story in itself. There was this gentleman that was running a mutual fund timing program out in California, and he wanted to retire. So he had heard by way of one of his portfolio managers of this guy, Tom Basso, over in Scottsdale, that did timing, did it well, and was also doing futures and a lot of other things. And he was at a stage in his life where he might like to have a ready-made fund to put in all of his different investment strategies. And so, he and I talked, and it was called Market Math. I bought the firm and took all the clients over, and we went through the agony of getting all the paperwork, as we know from, or maybe we don't know. You guys are in the Cayman, so you may not have that burden.
But we're painfully aware.
Yeah, it's really, really just unbelievable. So we got all that done, and off we go. So, I'm running Market Math with about $60 million or so, and I'm the largest investor in the fund. And so off we go. We've got a fee schedule that is 1 in 10, I think it was, where everybody else was 2 in 20. So I was like dirt cheap. No excuse there to not buy the fund. I went in over the subsequent year, and we were running, God, let me see if I can remember them all, 2 different currency programs, 2 different strategies and futures that were oriented towards me, another one that was for Wizard Trading that we had taken over and that we were just integrating, keeping their track record alive for them. And that was for Louis Lukac back in the days. And then I was doing some commodity option strategy, and I was doing mutual fund sector timing, all within one fund. And as you could imagine, all those strategies are going to balance each other out. You're going to get a little bit more of an all-weather type of thing where, I don't care whether the stock market's going up, mutual fund timing is doing well. If corn's doing well, maybe I've got a corn option on in the option strategy. It doesn't make any difference. So we had about an average of a 15, 14, 13%-ish type of return in the teens, fairly tame drawdowns of any kind. I went out and I tried to start talking to pool operators because I knew a lot of those from my futures days. And their answer was, well, you got this mutual fund timing in here. That's securities. We don't do that. I don't know. I don't want to get involved with having to deal with the SEC and all that stuff. Mm-hmm. So then I said, all right, well, let's see. How about if I do fund of funds? I'll go to New York City. There's a lot of those folks there. I would go from Scottsdale on a Sunday night, and I would come back to Scottsdale on a Friday afternoon, and I would do appointments from the time breakfast hit all the way through dinner and lunches and appointments in between. I counted 150 appointments I did, many of which I would take their own track record and Market Math's track record, and I would blend it in at 5% or something. And I say, here's your return to risk before. You add this in. Here's your return to risk after. It's improved. And they'd look at me and, yeah, I hear you and I understand the math, but we don't know what to do with you. We don't know which box to put you in and all that stuff.
That's hitting close to home.
So now it's way too close to home. Can we stop this right now? It's actually becoming depressing.
I know. Is it painful? You can have a sip of your drink. Okay. What ended up happening was after the 150 appointments, I raised, are you ready?
Oh, no.
I must be a terrible salesman. I don't know. I got nothing. And I said, okay, I'm spending $100,000 a year to comply with accounting and legal rules. I don't really need the money. Why am I still a money manager? Yeah. So I became a retired money manager, and I've smiled ever since. And it's just, you just kind of, you look, and these are institutional guys, you think they would understand the logic of it, but they don't. And so
you raise a really interesting point though, right? Like being in a box that allows institutions to slide you into a preconceived category is so important, and yet being confined to a box necessarily reduces the amount of diversity of strategies and instruments and markets that you can bring to bear in the fund or in the whatever vehicle you're using.
Exactly.
So you're having to compromise
and I was a partnership
substantially.
I had Market Math was a partnership, limited partnership. People had a rough time with that, and you had to have a little bit of the partnership. You have the problem of transparency. People can, get it sort of broken down inside the partnership when you get the accounting and all that. Actually, I don't know. Are you guys familiar with the Standpoint story?
We know.
All right.
We know Eric well.
Eric Crittenden.
I'm chairman of Standpoint Funds, and Eric came to me. I don't know. Gosh, it had to be 2.5 years ago, or I lose track of time. And we have this lunch that lasts 4 hours, and he lays this all out of how about if I'm thinking of doing something where I take stocks on the one side and I'll just get that exposure using ETFs or something. And then I'll do the other side using global markets in everything from currencies to metals to energy to all this stuff. And I'll design something that's very tax efficient and very diversified. It'd be one of the most diversified funds you could imagine. But we're going to make it a mutual fund, so it's a security, and that makes it easy for everybody to use it without having to deal with all of these moving parts. And I said, Eric, I tried to look at that back when I was still doing Market Math, but that was going to cost me $500,000 to put the investment company of Act 40 Act together. Mm-hmm. And I mean, the lawyers that you use for that type of stuff are like, they're the $500 an hour guys. And he said, but that's what I'm going to do. And I said, when he outlined it all and told me the investment strategy he was going to use, I said, you just invented Trendstat, my old firm, 2.0. That's what you just did. And I want to know what you're doing. I'm interested in this. So I'm now an investor in it. And I raised about 98% of the capital to start the firm. I did it in 5 days with some phone calls, and I had all the money raised that we needed.
Okay, Tom, you're officially an advisor for our firm. Stay tuned after the commercial.
No conflict there.
Did I tell you I'm retired?
Yeah.
That's definitely. I've had a lot of conversations with Eric recently about his shift from longboard to Standpoint, and the whole philosophy change and trying to provide an integrated solution. So I feel his journey.
Yeah, two things going for him. I guess you could argue because I'm the chairman, but we have two things going for us, I think, versus Market Math and my beating my head against the wall back in those days. One is that it's a security. So we spent the upfront money to get all the extensive, difficult legal work done. I mean, it's massive. And the second thing is the whole tracking industry back in the days of Trendstat, my firm, were just trying to get into computerization, and there was a lot of people faxing in their track records to these central depositories and trying to put out handwritten, printed newsletters that would go out in the mail once a month to various people. There wasn't this go onto the internet and slice and dice the industry, 500 different ways. So one of the advantages that I think Standpoint has these days is you can look at other sort of, globally diversified funds. I think Milburn's got one, and, there's a few others out there. And I knew Milburn back in the days when we were just, currency and commodity traders, and that they've gone on into, adding a lot of security stuff too. But I think there's a lot more ability to pick benchmarks that match up with what you're doing better, so that you can actually look good, at least when compared to other folks that are doing similar things. You don't have to compare yourself to the high-tech stock jockey that, has found the penny stock that's just did 2,000% return or something, and try to compete with that. So I think it's a little easier in that regard. But still starting from zero, running up to 85 million now. Yesterday, I guess it was. They're rolling. I'm very proud of Eric and those guys. I mean, they've been doing a great job. Board meeting this next week should be a fun board meeting.
He's learned a lot of lessons from his previous gig that, it's at his age. I was like at that level of his career at his age to realize what went wrong, what the audience wants, and then do a complete shift and start from zero. I mean, I was thinking about him yesterday. I'm like, how did he convince his wife that he was doing this again?
He's
it was
not
incredible.
Married.
Oh,
he's not married.
That's why.
Well, that'll do it.
Okay, that's a trick. I got to divorce my wife. Okay. All right.
She's watching. Is the door locked?
Makes
Is the door
more
locked?
sense.
Check the door.
But kudos to him for giving, putting something together that the audience wants, and
I think he also
putting a distribution approach too.
He and I have also had a lot of sort of in-depth conversations about life, not just money management. And we love our lunches. They usually go on for 2-3 hours because he's like maybe the son I never had or something, or a younger brother or something, and we get going, and there's not too many people he can start throwing statistical terms like he can with multi-syllable words that could understand what he's talking about, but I can. And so we both can speak at a very high level of math and investment technique and understand what each other is saying. But he has learned a lot of lessons, and I've also thrown in my 2 cents on life and trying to structure what he does over a very strategic plan. And I think he's taken a lot of that to heart, and he's nailing it.
Yeah. Well, Tom, you should. We just wrote a piece called "Stacking Returns" that deals exactly in that idea of multi-asset securities and like layering CTA and global macro on top. And I'll give it away. Product 4 is the Standpoint Blendex Fund. So you should take a look. I actually sent it to Eric to give us before publishing to give us his opinions. But it's exactly addressing. How do you give the world what they need, which is that 60-40, and how do you force them to stack some non-correlated alpha on top?
Yeah,
and now you can do that, as you mentioned. There's a series of 40 Act funds that provide that level of capital efficiency that didn't exist 2 years ago. Now we can do that. And
they have an NAV. It's just in the paper or on the quote screen, and people don't have to know that behind it is this multitude of like 75 different markets over here, and something like 3 or 4 different ETFs that are covering the equity exposure, and all these different strategies going on with both, and rebalancing periodically, and all that is taken care of internally, and you get one number at the end. And so your taxes are just, you bought, if you sold it, you got a capital gain. If if there's a dividend and you get a 1099, it's easy. And I think that's finally where, the success has come in Standpoint's, business, because of the fact that they packaged it right. And I think also I was on the bleeding edge when I was doing my multi-strategy single manager fund. There was maybe one other firm that was struggling, and they didn't get anywhere either. And nowadays it's a lot more common. So now people kind of know what to do it. There is a box now for those folks. So I think I might have paved the way a little bit way back when, after they started hearing it for a decade, maybe they started thinking, man, maybe we ought to look at this finally. But I was long gone at that point, smiling away into retirement. So I volunteered. I said, if you want me on the board, or they said, hey, you raised most of the money, all the investors in the firm. We want you to be the chairman so that you can run the board meetings and all that. And so it's fun.
Fantastic.
It's a great way to be in a money management industry with not having to get up in the morning.
It's like being a grandparent.
It is. Exactly. Always, we call them, another guy on the board and myself, we call the whole management team at Standpoint the kids.
Right.
That's what we call them. That's their collective name. I wonder how the kids are dealing with this. Yeah.
Mike, you had something you wanted to ask, right?
Yeah. Well, some of them could be our grandchildren, actually. Yeah. They're that young.
So as you think, I think we'll get into the sort of the more do-it-yourself stuff. I want to save that to the end, because you've got Enjoy the Ride and the programs you do there, and we can get into the some of the nuts and bolts of investing. But on the side of delegating some of the investment decisions, whether you're an allocator, an individual investor, or a registered investment advisor. What are some of the tips that you would provide, or some of the guidance that you would provide for those out there who are looking at a 60-40 portfolio where 40% of the portfolio is earning less than 1% and the other 60% is, equities, which are going to have certain, or discounted cash flow assets, could be highly valued. They probably are, will face, some volatility over time. Mm-hmm. What do you look for in a manager? What kind of style do you look for? What are your thoughts there?
Well, right now with a long run up in the stock market, could it keep going? Sure. I mean, in a market, as my wife reminds me of saying all the time, the market will do what the market will do. And so all of these markets can do strange things. They can do them for years. But if you look at bonds in particular, which is a critical part of the 60-40 mix that was so traditional with financial advisors over the years, that 40% now is yielding low single digits at best. And if it's a short maturity, maybe less than 0.5% or something. And yet, if you have interest rates go up at all, those bonds are going to get killed. So the return potential is like single digit, really low. And the risk of bonds, you could lose 10, 20, 30% on a long-term bond before it, recovers back. If you hold it to maturity and the company stays alive and everything, blah, 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 you still might make your interest rate all the way through into maturity. But if inflation were to fire up, and it seems to be trying to, you don't want a 1% return locked in, because that's going to be losing money to inflation. So bonds are a sucker's bet for the next decade or so, in my mind. And I know Eric agrees with me on that one. On things like real estate, I mean, we're just building a huge bubble again, just like almost we did in 2008, and nobody seems to be noticing it. Some of the insanity I've seen around here, I didn't liquidate. My wife, who's the real estate expert, liquidated all of our rental properties that we owned this last year. So we're trading everything in the liquid markets now, not in the real estate. Now, whether or not that proves to be good timing or not, who knows? But you don't want to, with real estate being such an illiquid asset, it's kind of hard to deal with rental properties, and then they have moratoriums due to COVID and all that garbage. It really gets tough. So you look at other assets. Stocks are going to go through their ups and downs, and we've seen in my lifetime, if you take 20-something% as your benchmark and worse, must be 5, 6, 7 times now I've seen that. And some of them, tech stocks in the tech bubble went down 80%. That's a pretty big hit to take. And I don't think a lot of people who have lived through it, or they just turn off the brain and don't study history, realize that that's kind of the risk you're taking on if you just buy and hold a strategy like that. And so for the advisors out there that are trying to give their clients something to think about, I have no problems with having a portion of a person's investment in stocks. I think I shy away from bonds these days. I just don't think it's going to add value over the long run. It might stabilize your money, but I'd rather be in money markets if that were the case, just to stabilize. But you're not going to get much of a return. Beyond that, I think you got to attack risk. Over the years, people have, like my father, the postman, he thought, I can't do the stock market. He didn't buy the mutual fund. Remember the story, right? Mm-hmm. I bought the mutual fund as the paper boy. He's the postman and a conservative father who's trying to provide for his family and paid off his house early and all those good things. He looked at stocks and said, he goes up and down all over the place. I can't take that. I need a conservative investment. So he put all of his life savings in CDs at a savings and loan. Guess what happened?
Uh-oh. No.
Savings and loan.
No, savings and loan went all bankrupt.
Yeah. In 1990.
He got bailed out along with millions of other folks who had CDs and savings and loans when Reagan era, the Federal Reserve ran it all up to about 20% on short-term rates. The savings and loan had a upside down yield curve and just put them all out of business. Mm-hmm. Right. So what my father did, if you think about it, is he tried to avoid risk of market movement, and he took on, without thinking it through, the institutional risk of a savings and loan. He didn't think it through. There's risks with everything you have out there. I was quoted once in the LA Times in an interview saying there's risk with US Treasury bills, which is considered the risk-free rate when you do calculations and the math and Sharpe ratios and all the different things that you use risk-free rate for. But there is no reason why Congress or the Treasury or something could one day come along and say, we're just going to go ahead. We're having a little rough time making all these payments. We're just going to forego paying the T-bill interest this month until, we're going to use that money somewhere else. There's no reason why.
Well, look, even the risk, it's just so deceiving to say risk-free rate. I think that's the biggest
it is
error made, because when you think about it, it may be considered a risk-free rate from the perspective of a zero inflation government. But even if you have low inflation in your own government, if your purchasing power against other currencies goes down, and you don't have to go you don't have to go to the 70s to see the US dollar lose 10, 15% against other currencies in the past, right?
Easily.
So you can just show them, look, you lost 15% versus what somebody in Europe could have purchased, right?
Yeah,
and
I've always, I've talked about net worth versus net wealth, and everybody hears those words and goes, wow, that's different. What do you mean? Net worth is your balance sheet. That's your assets minus liabilities. That's your net worth. Net wealth is what you can buy with that net worth. Yeah. Well, what you're talking about with the dollar drops by 15% or something, your net wealth, if you made 15% on your net worth, your net wealth stayed the same because the value of the dollars that it's all denominated in just declined by the same amount. So I would, what you're talking about is exactly right. And my advice would be, don't try to hide from risk. Try to find risk and attack it. Do something about it. Trade some markets that could make a profit. Like in my own personal retirement account, and people would think I'm retired and I'm doing this. I've got a position in like a Bitcoin future. I've got a position in NASDAQ index futures, both long and short. So let's say we go through a 50% down in the stock market. Well, that strategy is going to slay it. Bitcoin, I don't even know. Bitcoin may go down in the down market, might go up in the down market. But one thing's for darn sure, it's two different things. So I'm attacking risk by diversifying extensively, and I'm putting in place models that will force me as a trader to be involved in that move. And if it's a down move in stocks, I'll have hedges on my longs. I'll be in cash on my sector timing. I'll be cash on my momentum ETF investing. I'll be short the stock index futures. What else? Those are the types of things that are going to make me a lot of money on the downside, and I'll lose certain things here and there, but I'll be making it otherwise. But I'm attacking the risk. I'm not trying to avoid it. I think that's where a lot of people.
100%.
Water finds its level. It's insidious how water will somehow get through your roof, somehow get through your foundation. It's a nasty little animal that can just find its gravity, gets through everything. Risk is kind of the same thing. No matter what you do to try to, push it away a little bit, you got to attack it. You got to master it. So things like buying puts against the stock portfolio to, make some money on the downside. Things like, trading global futures markets in both directions, trading currency markets both directions. Those types of things can really help provide return streams to offset what are likely to be some stock market losses in a bear market. But what you also want is the stock market to perk up the portfolio when these other guys are not doing well. It's the point of diversification. You're spreading the risks, and that's
singing the song of stacking returns for sure. Yeah, the paper we just published. But how do you differentiate between sort of the similar and same type trades? When you've got this array of trades on, how do you think about the beta risk that you might be experiencing in NASDAQ and its relationship to maybe even oil or how do you kind of think through those similar trades in order to maximize the opportunity for diversification in the suite of trades you have on?
Yeah, some of it is a little easier than others. It could be subtle, I think. If I'm looking at, say, putting on a trade in, let me coin an example here. I'm going to buy corn in the U.S. on a futures contract, and at the same time, I've got a trade going over to sell gold in the futures markets. So I'm going to go short. Would those two trades have very much to do with each other logically? Just
Wouldn't
thinking
think
it
so.
through, I mean, common sense would tell you probably not. Would crude oil really care what lean hogs were doing today? There might be a little energy usage on the farm to keep the hog pens warm in the winter or something, but no, and there
Yeah.
might be some tractor. You might have to buy fuel for your tractor to go out in the yard and go out in the farm and pull in some feed. But logically, over the short run, there's such different markets. You're not going to see a lot of stuff. Now, when you get into, say, NASDAQ versus, say, Russell 2000,
Right.
there would be an example where you have two different indices. And today I was noticing that the Russell was my worst performing stock indices to the downside, and the NASDAQ was actually the best performing at the same time. So there was a little difference there, and that flip flops up frequently. And so the thing to do there is to not overload yourself with just equity. If you're going to, I mean, at least dial in a little bit of the different levels, like small cap and large cap could easily be different. Things like NASDAQ, which is tech oriented, versus, say, a broad index like Russell, are going to probably give you some amount of diversification. But let's face it, if the tech stocks went into a 50% dive, chances are the Russell index is going to be down 40, 60, 45, 35. You're not going to have a good time. They're all going to kind of tie together a little bit. So that's why I'm a big fan of seeking out as much diversification as you can possibly do. And you can use correlation coefficients if you want and try to find examples of two things that you correlate with. I mean, you can do that in an Excel spreadsheet. And there's firms on the web that you can dial in and get free correlation coefficients on some markets. You basically want about zero. You don't want +1 because that's highly correlated. You don't want -1 because now one of your investments is always going to be losing while the other one is making. You'd like them both to be profitable if they choose to be profitable. The only way you can do that is to have zero correlation, and those are very hard to find. But that's I guess the holy grail if you can figure it out.
That's what makes it interesting.
Yeah.
Mm-hmm.
So, Tom, over the years, as you've traded these many systems, I'm curious. I've heard both sides. I've heard people, like actually Eric has said to me that the old-fashioned trades that worked 30 years ago continue to work today. Why would you do anything differently? Have you found over the years that there are certain ways of trading that just got arbed out and you can't do anymore? And do you evolve your trading even during retirement?
My trading has evolved in retirement quite a bit. For starters, I can take more risk than my clients can. I can live through a 15 or 20% drawdown. It doesn't affect me. I've been through lots of them. And so my average client, they'd be firing me. So that's one change right there. Second change is you realize when you're an individual, even myself with, fairly a lot of zeros around, in the back of the account, that I still am nowhere near like a multi-billion-dollar money manager where you have to move, $4 billion in and out of markets. So if I want to put one contract into a lumber trade, I can actually pull that off. That's an advantage that an individual investor like me has. And I would agree with Eric's statement with respect to institutional money, and what he's doing with Standpoint is brilliant because it's designed to handle billions of dollars efficiently. And what I am doing personally has nothing whatsoever to do with what Eric's doing. And I appreciate the differences, and he's right from the institutional standpoint in moving those sizes of assets. What you basically come up with is a currency, debt instrument, stock index account. You might be able to throw in some precious metals or something, but the volume is all in those markets. You could never trade a lumber. Lumber won't make the top 75 markets on liquidity measurements. Right. So basically, small investors, if they want to get into some diversification, have some advantages. And some of the old ways of trading that I've been doing since Trendset days still do work, and I still have made some very nice returns. So, but I'm doing it with small amounts of money.
I'd love to, because I want to go back to what you said a little earlier, where you first had the conversation with Jack about the new Market Wizards book, and Jack remarked that your track record was kind of uninteresting, and then
I think his exact word was boring.
Boring, sure.
Yeah.
So, and then you got started talking, and he realized that you were actually really doing something different and really interesting. Maybe would you mind going into that in a little more depth? How would you characterize the difference between how you attack the problem and how some of your contemporaries were doing it?
All right. A lot of my contemporaries, all the way back, I came up with the turtles, for instance. So you had the Richard Dennis story and training the turtles, and a lot of the turtles were my competitors, Jerry Parker and those guys. Susan Show, I think, was one of them too, maybe. Anyway, what ended up happening is I was a chemical engineer, and I went into the money management business. I never was on the floor, never worked for a brokerage firm, never was with another money manager. Straight from chemical engineering into running a management firm. And Process Engineering 101 is your first chemical engineering class. And I'll sum it up this way. Chemicals come into the tank, you process the chemicals, you ship out the fluid on the other side of the tank. You ship it by rail car, or by pipe, whatever. So that's Process Engineering 101. Well, I look at the money management industry, and I'm starting to get involved, and I'm starting to automate. And I'm realizing that here I am bringing down satellite data off the dish. I'm processing it with my PCs, and I'm shipping out orders. And I realized that while everybody in the world seems to think of me, thanks to New Market Wizards and Jack Schwager and all the different things that interviews I've done and everything, as a trader, I never thought of myself as a trader. I thought of myself as a businessman running a trading operation. And what can I do to make it more efficient? How can I get better data? How can I cross-check the data? How can I speed these programs up so we can get our afternoon runs done quicker? How can I provide my clients better transparency so they can come in anytime they want on my website and sign in with their password and get a immediate reaction on where their account is that moment, even everything real time. And my competitors did not have that kind of mentality. Their attitude was, I come in, leave me alone. I got to trade for these many hours. I can't talk to the clients during that period because I got to focus. And so it was a very different animal. And I approached it as a businessman. And that's really where the big difference was. And just like any businessman would, you would ask yourself, what are your clients looking for? Are they looking for this flashy, Paul Tudor Jones type of story, and Paul was one of my competitors as well, and he's done very well for himself. But I'm not Paul Tudor Jones. I don't want to wake up in the middle of the night and worry about where cotton is or anything like that. I had competitors that would have quote machines down on their side of the bed so they wouldn't wake up their wife. They could wake up in the middle of the night when they're going to the bathroom and look down at the quote machine and see where the euro was. I get 8 hours a night. I sleep every night. I don't ever get up in the middle of the night and worry about anything. So I think that's where, I think Jack finally figured out. Jack's sort of a caffeinated New Yorker kind of type mentality. He a couple of cups of coffee and he's raring to go, and that's good for him. There's a lot of people like that, it seems like, in New York, as I've been there over the years. But that type of mentality where you want to be hard charging and just keep pushing the envelopes and all that, it leads to the other side too. It leads to the emotional crash when things don't work out, or you have the markets are just doing insane, stupid stuff, and you're looking at the red painted all over your screen and wishing you were somewhere else. And in my case, those red numbers tend to be mixed with green numbers, and I'm more worried about the overall, and it smooths it out a lot, and it keeps you smooth. I think Jack envied the fact that I could be labeled a trader and yet still have a lifestyle that was, most people would say is pretty good.
So can I pull on that a bit?
Yep.
It sounds very like we're quants. We are everything you described about process, about working on the business and getting the right data, improving, putting the process together and focusing on the process. Were you more of a quant back then? Like you talked about Excel sheets and computers. Like, were you programming as an engineer back then?
I bought a Trash 80 from Radio Shack and put it together myself, and I had the first PC from IBM coming out. I had it. I bought an IBM AT when they came out. This was all through the early 80s. 1980 was my PC that I bought. And I pushed those things as fast as I could and as hard as I could, and tried to automate at minimum, like moving average type things and simple things that wouldn't overpower a little PC with 5 megs of total memory or something on their disk drive. I mean, it was insane what we have today in my laptop that I take with me everywhere I go, and it dwarfs all of the computers at Trendstat, all 40 of them put together, one machine.
Oh, the computers in your headset are more powerful than the computers that
there you go.
We were running back in the 80s for sure.
Yeah, exactly. Your phone can do far more than our mini computer from Digital Equipment back in the days that took up a whole room, had air conditioning, and had 5 meg removable disks that were this big and about that thick and were heavy to lift. And we went and spent the money for the optional replacement disk so you could have 10 megs of memory.
Oh, wow.
You couldn't have them in the computer at the same time. You had to have one or the other. But if you were smart at partitioning your data, you could actually have a little bit more. But
so nowadays, you had an alpha in your squats so that you could rapidly switch your memory, your disks when the time came.
Well, we always ran backups. We'd run disaster days. That was well known. Some of our clients thought that was humorous that we would do that, but we would operate Trendstat from basically my house, which was the backup facility. And certain people would bring computers and other people would go to their houses, and we would do everything by phones and try to get our data in and try to send out our orders. And meanwhile, a skeleton crew would be back at Trendstat running the normal operations. So the client was protected, but we were attempting to do everything on an offsite location just to test ourselves and see if we could do it. And a lot of firms
recovery when it wasn't required by the regulators. Good on you.
Exactly.
So Tom, I guess the contrast was that the traders that were that your contemporaries, they were more like clicking mouses, picking up the phone, doing trades, looking at charts, visually making those trades, and you were
falling down to the floor. How's the floor? What's the floor say?
Right. So what one envisions as a trader being, and you were back then already automating a lot of the trading and operations. Yeah. Wow. Okay. Well, that certainly makes a difference, right?
In the late years, I'd say in the 90s, 0 decisions were made discretionarily. I mean, the only discretionary decisions were what went into the strategies and systems and all the computers. That took my entire intellectual capability, and our research staff would sit there in long meetings brainstorming about, do we head this way? Do we head that way? What's the advantages? What would be more robust? How can we statistically determine whether this approach is going to be better than that approach? But once it was, went through testing and was approved and we got everything ready to go into production, we turned it on and that was it. We ran it.
Were you using any unusual indicators that were not very common back when you were running with your full capabilities?
I won't be able to explain this at all because it even to people who understand what I'm doing, it kind of comes out convoluted. But I started out so far before computers came in that I was on point and figure charts, if you know what those are.
Yeah.
You know,
Yes,
the X's and
Very
O's.
familiar.
Yeah.
And I tried all sorts of different ways of using point and figures, and I had a problem with them because there's the size of the box is one variable. So in Jack Schwager's term, degrees of restriction, which I'm very proud of him for coming up with that one, because I think I've used it a lot. The more parameters you put in anything, the less robust it is.
Absolutely.
So in a point and figure, you got these squares. And you got to have the number of reversal squares. So your x's going up, 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 making new highs. And then how many squares do we need to go down before we'll start our row of zeros?
Yeah.
And back and forth you go. And then, people have gotten into pattern recognition, all sorts of stuff. But even if you just use simple breakouts, which is the simplest of all things, you still have these parameters that are fixed. And I always looked at the market and I said, like I could certainly go back over the last 3 years and optimize it and know that it should have been a 4-box reversal and a 0.75 box size just by running lots of tests. But that won't be the optimal for the next year, almost assuredly. So you need a way of being able to make this flexible. So then I started looking at bar charts started coming in, computers started coming in, people started putting, with websites and even with software, you now have fancy graphs with bars on the screen in color, green for up, red for down. And you started looking at that and you said, wow, that's all the information. There's nothing preventing you from knowing what's going on. And I see those same top of the X's and bottom of the O's and the top of the X's and bottom of the O's. I wonder if I could apply sort of point and figure to bar charting. And I did. I created what we called it Trendstat PF bar, point and figure bar. And trying to explain all the little nuances of it would be a little bit more than we want to cover in a cocktail hour. But it did work fairly well. It was a little more flexible. It always would get me in on every major move, always. Could never miss one. It would whipsaw me. Yes, all trend following models do have their whipsaws. I figure about 33% reliable over my lifetime. So 1/3 of the time I'm running a profit. 2/3 of the time those trades are losers. So you cut your losses short, you let your gains run. You're running on our shorter term program. We were running about a 3-to-1 return to risk on the average profit to loss. And on the max trend, I think, which is a lot longer term, there was times we were up in the almost 7s. So the reliability wasn't 33 there. In max trend, the reliability would drop down to like 28 or so. And we'd have like 7.5 to 1 return to risk ratios. When we nailed it really, really well. And one of those gains, it would pay for the whole year.
Yeah.
That's I think it's so behaviorally counterintuitive, right? That's why that's probably the largest barrier to entry, or edge, if you will, even for many institutional managers, some of which the whole structure doesn't really allow for you to take 8 tries to get the one try that actually hits all the returns. So it's interesting because as we were talking, what's the edge? Well, that's definitely one of them. There's a behavioral edge here that, most people listening to this may not understand, that you will put on more trades that are losers than are winners in an absolute sense. That doesn't mean your profit's not there. It just means that you're going to take a lot of these losses. They're going to be small.
Exactly.
In order to find the one where the trend change is truly going to make a big profit.
A great way to think of it is, and I've said this a million times too, is every trade, the new traders get in, they're going to do their first trade and they're real excited. And, is it going to be a winner? Is it going to be a loser? And all that stuff. I like to think of it as I know that at least historically, I've been running 33% and 67% winners and losers. I need to do 1,000 trades to make those statistics come out. So this trade is just one in the next 999 trades to get to my 1,000, so that I can get to my 33% and my 67% and my 3-to-1 or whatever return to risks on the average returns to risk. It's a statistical game, and it's not. You don't want to get excited about a trade. You don't want to get down on a trade. It's just one more data point.
Mm-hmm.
What's been fascinating for me in the last year is I'm in this crypto group chat. And so when crypto went to the moon, somebody suggested, oh, you got to listen to these guys. They always get it right. Like, these are traders, they're doing technical analysis, whatever. So I started listening to them, on the side as I'm doing work in the mornings. And of course, during the boom market, they're talking about how they were almost poor. A couple of the guys I met when they were like down the dumps, and they found crypto in March, and then they learned to trade and read all the books.
Yeah.
They probably read your book, and now they're like veteran traders. And you got to listen to me because the guy's called the sniper. And so it goes like 12 months in a row where this guy just can't lose, right? Everything he says turns to gold. And when the market started going down, I started watching them again, and you could just see the desperation in these guys' faces, right? Like week after week, loss after loss. Everything that they said just did not work out for 2 or 3 months. They ended up going from publishing every single day on YouTube to once a week, and they didn't even know what was going on. They couldn't understand it. They completely gave up. And of course, that's like, yes, you're going to be a massive trader if you are born in a bull market, right? Everybody gets hooked.
Well,
but you got to go through that experience, right? Because indeed, especially in crypto, you're just losing. And then August, you're making all the money again, right?
Yeah.
It's interesting because I want to come back, Tom, to your 4 years in development.
Mm-hmm.
Yeah.
And one of the things that I thought was, were you lucky because you had to work so hard for 4 years and because it didn't work? Because, you differentiating between, just as Rodrigo said, someone has a viewpoint or a set of skills that they're going to convey to the market, and the market just happens to be harmonizing with that set of skills. Mm-hmm. And then they're mistaking what is a coincidental sine wave of their skill set and the market's personality as skill when it's simply luck. And I'm wondering, in those 4 years, did you think about giving up? How were you able to come to the conclusion, in fact, that, hey, my skill is actually building here? And, because it's really hard not to either give up because of 4 years of getting, punched in the face, or getting overconfident because you make a foray for several years and you happen to be in a bull market and you have a bullish bias, or the other way around. You're in a bear market and you have a bearish bias.
I think I was a pretty good student of history. So for starters, that helped me. I think a lot of people confuse bull markets with brains because they are just looking at whatever historical data happens to be on their quote platform, which is the last 6 months or last year or whatever. And, oh yeah, I could have done here and here and here, and look at all the money I would have made. But they never go back to 73, 74. That doesn't exist on the quote machine. Mm-hmm. And I think that's one thing. Second thing, and I'm a data cruncher, so I can see all those old bear markets, and I see them on the chart. I see a drawdown or anything on a chart. That's where I'm spending my time doing my research. How did that drawdown get created? Which markets contributed to it? Was it increasing volatility? Was it decreasing volatility? Was it sideways action? Was it any particular one trade? Maybe the data is flawed. I've seen that happen. You got one big down thing and you go into the data and it goes, well, this is stupid. The low on this day here is, or the open is lower than the low. That can't happen. The open's got to be inside the high low. Stuff like that. I've seen it all. And so that's one thing. The second thing is I would log in all my trades back in those days. Everything was by paper. And so I'd say, okay, I think I should buy corn or buy hogs or whatever it is I'm doing. And here's why. The point and figure chart is doing this and this. I'm going to buy this breakout here, and I'm going to put my stop there. And of course, I'm way over leveraged because I don't have enough capital in my account. I'm making every rookie mistake, which then I realized when I do the math, it would be a lot better if I had more assets in my account. So I started working real hard as a chemical engineer, and I got lots of promotions and lots of raises, and I poured money into my accounts and got them bigger so that I could handle better diversification by market, better position sizing, which I wrote the book on a couple of years ago.
Let's dig into that too, on position sizing.
Yeah.
Like how do you position size? What's
Well,
the max
to finish
risk?
what we're doing,
finish the
I'll
first
get
one.
that in a
Yes,
second.
please.
The last thing was that I was constantly, seems like every year, getting less loss. So the combination of studying history, the combination of learning tricks along the way that made me think this is really important, and I can see mathematically where it would be important. And finally, actually seeing it come out in improving results, even though they were still losers, I was getting closer to it. And with a small account, I could afford the loss. And by the time I started trading, the 100,000 plus type accounts, I was well down the learning curve and successful. Now, in the position sizing question you bring up, I always think of a full trading strategy as three things. At least. You could probably fine tune it into more if you wanted, but in simple terms, you need to have a buy sell engine of some sort. You got to say, if the following X number of things happen, I'm going to buy at this point. That's the first thing. If you don't have that, then you're, I guess, Paul Tudor Jones discretionary. It looks like cotton's going up. Let's go buy cotton. I don't know how. I'm sure he has some things that are a little bit more systematized than that. But in essence, you don't just wake up in the morning with no idea what the world's doing, and then all of a sudden look at a quote machine of some sort and say, I think I'll buy lumber today. It looks like it was going up the last 2 days, and I'll just jump on that. You can do that, but it's going to be a very randomized performance, and you're going to have a lot of stressors thrown your way. It's not going to be a fun ride at all. Position sizing comes down as the second part of the puzzle. So it's, where do we buy and sell, buy and sell engine. How much do we buy or sell? And in all the studies I've ever done, that is more important than where do we buy or sell. You could flip a coin, do great position sizing, trail your stops, randomize across 20 different markets for 20 years of data, run 1,000 run Monte Carlo simulations, and you will tend to make money. Why? Every time you flip a coin, and in the afternoon I'm flat, flip a coin. Heads, I buy at the open. Tails, I sell at the open. You will always get, sooner or later, every major move that you want to be in on. As long as you trail the stop, you're going to exploit a lot of that move. That's going to pay for a lot of your mistakes, and you're ahead of the game. I would never trade that strategy. It'd be stupid. You could do better than that. But the point you make it with doing that is just by watching your position sizing and making sure. Larry Hite and Mint back in the day, and he was in the first Market Wizards book. Brilliant mind. I love Larry. He was the one that made the statement, we try to make sure our bet size is the same every time. And when you start thinking about that in math terms, because I have the math background being an engineer, I read what he said a little different than a lot of people. A lot of people might say, well, he always does 100 shares of everything. No, I thought it different than that. I said what he's doing is taking his risk of that trade first. So the buy-sell engine, knowing where he's going to buy, where he's going to sell. He knows the risk. How much do I buy to make my bet size on that trade the same as the next one, which has a completely different risk? I might buy less of that one, more of this one, and more in low volatility periods, less in high volatility periods. By doing that, you make every day the same, and you create serenity. That's where the name comes from, probably, because every day is sort of, I've always got the same bet size on. So does Larry. The third area, and the most important of all, beats the other two, is what we talked about throughout a lot of this discussion today, is the mental side. If you don't have your mental side screwed on straight, you are going to find a way to completely screw up those first two. You'll override it. You'll ignore it. You'll talk yourself into taking the profit too early. You'll get emotional. You'll get anxious, fearful, greedy, impetuous, whatever. I mean, and you will mess it up. So I've always said, if I could be a young trader talking to myself now as I was a young trader, I would say, work on your own mind, work on your awareness, work on your discipline, work on, understanding the strategic plan that you have to try to live through with all this day-to-day stuff, and then go into position sizing. Then worry about your buy-sell engine. Everybody does it the opposite way, including me.
Knowing
everybody,
the path and walking the path are a little bit different.
I'll tell you, I did 3 webinars just for a test. I got Zoom account and everything, and we're in, there's nothing going on, COVID. My wife loves to be the technician over here on the other computer, so I do one webinar. It's called buy-sell engines. We had to increase our Zoom account up to 130 from the 100 that I signed up for. There was so much demand for it. I then did a second one. It was called How to Size Your Positions. We got about 45 people, I believe it was.
Correct.
The last one was going to be on the mental side of trading, dealing with investment psychology. We got 20.
Wow. I guess that
tells you everything.
Yeah.
That tells you everything right there.
Yeah.
So all these people that want to buy-sell engine secret don't realize that they could almost, not quite, flip a coin and do just as well in there.
Well, that's why Bobby Axelrod has his psychologist in-house, right?
Yeah.
You guys know Bobby Axelrod in Billions? Come on.
I don't think that is something that can be taught, though, either, right? Like, I think that's something that you need to learn. Like, you can be taught, once you realize that the mental game is important, you can be taught how to bring a better mental game. But I don't think you can be told in advance that the mental game is of utmost importance without living through those experiences of being in large loss positions, being over leveraged, being in the trenches with the bullets flying, and experiencing the emotion and the pain of that. You can't know that the emotional game is that important until you lose because of a bad emotional game. Would you agree with that?
I suppose. You could also, though, learn from mentors or, read books and market wizards and hear stories like the ones we're talking about. And I think you can learn from that and say, wow, he's really making a big point of this. I wonder how I can increase my awareness of what my mind goes through, because awareness leads to discipline. If you don't know you're deviating from your strategy because you're getting greedy, if you're unaware that you're that way, you're caffeinated New Yorker just running hard and, man, the screen does this, I do that, man, just keep going, no thought of. If you're not aware that you're making an impulsive decision, then you will have a hard time correcting that back to the strategy, and getting back on plan. If you're trying to diet and lose some weight or something, and you see the chocolate cake and you just snarf it down, because it tastes so good, you can't do anything else. Well, you got to have an awareness. Wait, that's not, I'm keto. That's not keto.
Yeah. Exactly.
Wait, that's not going to work. So you got to have that awareness. And there's lots of books on awareness that help you in all sorts of life. It's not just trading. Awareness would be useful to understand how you are dealing with the environment around you. 24 hours, at least the waking hours. I don't know that would be very useful while you're sleeping, but
meditation is one of the key points of that.
Meditation.
When you meditate, you're helping yourself be aware of what your mindset is. But go ahead.
A lot of people, in particular, I had a guy once from some transcendental meditation place in Iowa that he lived in a town that was all TM guys. And he asked me whether I'd ever done meditation. And I said to him, very interesting, and he was profoundly floored by it. I said, I try to be aware of what I'm doing all the time. And when I'm doing stuff, I have more stimulus to be aware of. When I go to try to meditate, I'm in a quiet spot. I'm blanking my mind out. Yes, stuff bubbles up into my mind, but I'm not really hitting myself with potential stressors like you would if you're on you got the quote thing in front of you and your markets are, red, green, and all over the place. If you can then meditate or be aware of what's going on with your brain, then you got lots and lots of examples to think about and control, and think about, how can I deal with this? How am I aware of this? What is the corrective action? Those types of things. If you go into a closet someplace, dark closet, and there's no stimulus, I have a hard time increasing my awareness.
So I've been a lifelong meditator, and I think it's a big misconception that meditation is about trying to be as quiet as possible. Like if somebody comes in and bothers you during meditation, you get pissed off, you're not meditating. You haven't learned a thing, right? In fact, open awareness for traders, I think, would be the best. It really is. Meditation should be taught in open, loud places, and the goal being to be completely separated from your emotions and your thoughts. You're just watching things happen.
You're watching the movie
in any way, right?
You're watching the movie of your life. You're not doing anything. You're just watching a movie.
If you're taught that meditation is not the 10 minutes that you do in the morning, but rather a practice that you need to be aware of all the time, like you said, you are constantly aware of your surroundings. I think we're doing a disservice with people saying, find a quiet spot, go to your room, close your door and do 10 minutes of just silence. It's not going to help at all. The other thing that I see you do, and I know that some of our traders do as well, and I've done my whole life, is journaling. That's a stoic practice, right? So stoicism, I think, go hand in hand with awareness and meditation, because stoicism is about, before you go to bed, you journal what you did and how well you did it and what you could do better, and then what you're going to do tomorrow. And by doing that, it's a natural practice of understanding and improving and watching yourself do the things that you do. And as a trader, if you're not doing those things, journaling is so important as a trader. If you're not doing that, then you are missing out on an opportunity to learn. So back to your statement, Adam, this idea that people need to live it. I've played poker half my life, right? I know a lot of people that have been in the trenches playing every single day, continue to play, and just bleed money. They've never learned, right? So they've been under the stressors. They continue to get stressed out. Just being under that is not enough for you to become a good poker player. None of them read books, watch themselves, watch the tape after they talk to me about why they did well and what they did poorly. It requires both, right? You need certainly a person that has read all the books and done all the meditation but never played poker is not going to be as good as a person that's read all the books and done all the awareness and played poker. You need both, but certainly one without the other is unlikely to breed success, in my opinion.
Right. Well said.
Well, that's we've had you for more than an hour, and I think you have a golf game to get to as well.
We're reasonably flexible.
Are you? Okay. Great.
Yeah.
So, do you when you run your seminars? I think are you still running sort of your trading?
With the seminar, COVID's been tough on us there, but Lawrence Bensdorp was a very interesting guy, and he loves wine. He could do a wine one with you. He's out of Brazil these days, and he runs a thing called the Trading Mastery School. And he went through the THARP Super Trader program. He's learned a lot. He's come from knowing nothing about trading really, and didn't even graduate high school, and went through the typical teen years and 20 years doing all sorts of things that were fun but not necessarily career building. And of course, he's matured in his older years. He and I got together and I said, your book on multiple systems trading is still what I recommend to people to read. It's such an easy to read book on automating your stock portfolio, or whatever he called that book. And it's available on Amazon. I said, that plus the way you teach at Trading Mastery School with the profiling of all the different aspects of your life, like how much time are you going to spend developing a strategy, how much time each day are you going to spend executing your strategy, how much money do you have, what skills do you have, blah 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 blah, long list, right? I said those two things alone are masterful parts of the trading puzzle. I bring with it the book on position sizing. I can certainly explain buy and sell engines. I can get into the mental side as good as anybody because everybody knows of me as Mr. Serenity. And we could both wrap it up with some kind of an action plan. So we can almost do 2 days of a great seminar and have a lot of fun doing it. Because he and I are friends. We get together, we'll have some wine, we'll go out to dinner and see each other for a weekend. And we always travel to beautiful places. The last one was in Miami at the Mandarin Oriental, which is right on the water. Gorgeous place, looking over downtown's Miami lights. This next one coming up is going to be in Scottsdale, my hometown, and it's going to be at the beautiful Phoenician. And we have such a beautiful venue on that one. Dinner is going to be in the Sunset Room, looking out on an Arizona sunset. It is going to be a lot of fun. And so he and I have a lot of fun doing these. But we find that by keeping the group to 12 or less, we get to know everybody's names. They open up. They sit next to me at lunch and ask me more personal questions. So it works that way. And we don't see it as anything that we would want to go Zoom and, have 100 people there or something. That would never work the same. But we don't consider it work. For us, it's kind of like we get to see each other and we have fun talking about trading for 2 days, and it pays for itself, covers all the costs, and we get a very nice vacation for a couple of days.
Nice. Yeah. So you're certainly not doing it for the money, I would imagine. So
no, I don't need the money.
Out of passion.
And sometimes I tell you, frankly, between Lauren's busy schedule and mine, it's sometimes a little difficult to figure out when we're going to have on the next one. So we don't do them every other day or anything. That's for sure.
Mm. Is the one in November sold out, or is it?
We got 6 seats taken and 6 to go. And I just put out a social media post yesterday. And I sent out emails last night. So I haven't seen anything come in today so far, but haven't really been looking lately. So.
Well, there you have it, listeners. Yeah. There you go. You get on that.
Yeah.
In your so you're retired now. I'm curious. A lot of people would want to do what you do, but you're a veteran. You can probably do a lot more. How often are you trading on the daily?
I have 53 or 4 positions last I looked. 7 different strategies. And it takes me exactly half an hour roughly to get through it.
So you wake up in the morning, you do your thing, and then
No, I do it in the afternoon. Do it in the afternoon after the markets close.
Right.
I put the orders in for the evening session and the next day, and I'm good for 24 hours.
So this is, for somebody that has the time, you can teach people that spend, enjoy their days and actually make it profitable for themselves. They do it right on a once daily. That's interesting.
Yeah, once daily is enough. I mean, I always think of all that price data as noise and information, and your job is to get rid of the noise and ignore it and to get the information. So from a trend follower's view, to be simple, market's going sideways, this is noise. We don't want to even do anything. But if it gets above here, we want to buy it, and if it gets below there, we want to sell it. You can go to cash, go short, whatever you want to do. Each strategy is different. You can design them all sorts of different ways. And you can do this noise over the next hour, or it could be the next week, next month, daily, lots of different time periods, lots of different markets, but the same concept holds true. So a computer can look at that and apply various maths to it to say, okay, here's normal range. And the normal range could be going this way too, up the page, or this way on the screen. Yeah. So it's varying, but it's varying on an incline. But you still want to ignore all that nonsense, or you're just going to be whipsawed a lot. So I'm just trying to make it easy on myself, and I don't do a lot of trades. I'd say on a typical day, like today, perhaps, I think I saw a cotton trade go over earlier. Might have had an options trade, a spread trade go on. I might have done 3 or 4 trades out of the 50-something positions. And a lot of those trades might be just reversing from long to short or short to long.
And out of the 15 strategies that you're running, are they all trend-based, or are you adding other things like mean reversion, seasonality?
I would say that I've got, longer term, say 21 days and beyond, would be some of my sector timing with ETFs and some of my futures trading, the bulk of my stuff. Then I've got about 5 strategies that would, to a lot of people, well, no, let's see, 1, 2, 3. Got 3 strategies that I think would be, to a lot of people, it might look counter trend, but what I'm really doing is trend following on a very short-term time frame. So I'm 9 days or less. So I'm picking up some of the noise, but I'm getting trends and exploiting those. And then there's probably 2 that I think I would consider largely counter trend. But even there, I'm sort of looking for a condition, overbought, oversold, and then kind of going the other direction out of it. So you could argue that that might even be trend following, but it acts a little bit more like counter trend trading.
So what happens if you're golfing at 4 o'clock and you'd rather, not leave to go and put the trades in? Do you have somebody that you can call on to execute for you?
The markets give me from, in this time zone, 1 o'clock in the afternoon all the way to 6:30 in the next morning is when a lot of the markets really truly open and start moving. And some of the commodities don't even open then. So stuff like maybe
you're trading
lumber,
in the morning,
cotton.
then off of a late an
They're all
afternoon
stops. They're all stops.
close.
It's afternoon. I put the stops in. They're good till cancel. So if I'm out of commission for any time in the next 24 hours, I'm still good all the way through to the next close.
Right.
I've got everything covered. So there's really nothing for me to do. I might as well go out and golf.
Yeah.
Or work on the landscaping, or cook dinner, or go work out, or
what is a realistic expectation for long-term returns in these types of ventures? Or is that I know it's a really hard question to answer,
That's
but I know
really hard
how much do you think about it?
It really depends on how much your position sizing is. For instance, on risk, on my futures trading, I'm down at this point to 0.5% of my total equity is what I have in any one position. And that's by risk. So that's from where I'm getting it to where the stop is. And then I measure my volatility by a 21-day average true range. So that's the volatility of that market. And there I'm starting my positions at 0.2% volatility. And that still gives me returns where I got days where it swings 1%, 2%, 0.5%, 0.6, 0.7, up or down. I could lose that much too. That's still moving pretty fast for most people. But I'm down in very, very low risk range. And I've got a whole bunch of other strategies that are fighting. So this one's losing, that one's making. They're forcing get me towards zero, and all I'm trying to do is to create sort of a straight line up the page. Try to keep things stable and.
So is that current sort of risk appetite a function of your personality and stage in life, or is this you and your view on the markets at the moment, or a combination of the two?
It's a combination of a little different than what you said. I would say it's my stage in life. I don't really need to make a whole lot more money. I'm very comfortable. Secondly, but I'd like to cover inflation and increase my net worth. I'm not idiotic that way either. So I don't want to put it in money markets or something and sit there and lose to inflation. Long term, I'd be in trouble. So my goal is to try to make money, beat inflation, increase my net worth and wealth. But at the same time, the other side of it is a concept of the geometric nature of drawdowns. If you draw down 10%, you have to make 11% to get back to break even. If you're down 50, you got to get 100% to get back to break even. So the closer I can keep it to zero drawdown all the time, while still pushing my portfolio with the markets upward, the better off I am. I get my returns to keep me in touch with inflation, but I don't have to compound to get back out of a hole that I've dug myself in if I get too much risk involved in it. So keeping the risk low and just keep posting some good numbers day after day is the trick, I believe. That's the way that I like to look at it.
Preaching to the choir.
I think Eric would agree with me at Standpoint too. I think he's of the same mentality. If you watch the returns of that fund, it's pretty stable. Yeah.
All right.
Love it.
Well,
90 minutes in, we're going to let you
90
go to
minutes
your 9 holes.
Yeah, we're going to
And,
go out and play 9 holes in beautiful weather up in the mountains of Arizona.
Oh my
So-
God.
I love it.
Sounds
Well,
glorious.
now, Tom, before we go, first of all, everybody who's out there and you made it to the end, hit that like button. Make sure you're sharing this trading wisdom with the rest of the world. And Tom, where can we find you? I know you're enjoy the ride.
Enjoy the ride.world. Right
Yep.
after my name there is the website. You can find
Twitter
a
handle
lot of
too.
different connections there. And there's all sorts of free interviews there, lists of my recommended reading books that include some of my own books, but some other people's books that I really liked over the years on trading. My hedging technique is outlined as an example of what you can do to pull together an idea. And I just go ahead and show people how to do that as an example so they can maybe start inventing their own. The seminar is there if you want to sign up. I'd love to see you in Scottsdale. So everything Tom Basso is on there. But I'm also on Facebook, Twitter, MeWe, Parler, LinkedIn, Instagram. I hardly ever go on, but I'm on there. So you can find me a lot of different places.
amazing.
The tech
Tom
master
Basso,
himself.
omnipresent. Yeah.
Yep.
Love it. Well, thank you so much, Tom. Really appreciate the generosity of time and also the generosity in sharing your knowledge. And I know you do that all over the place, and it's just pretty incredible.
I have fun doing it. I meet new friends and talk about a topic I dearly love. So it's all good.
No, that's
Fantastic,
wonderful.
Tom. Thanks for joining us today.
All right.
you.
Thanks.
Cue the music, Ani.
Today's podcast is brought to you by Horizon's Resolve Adaptive Asset Allocation ETF, which trades on the Toronto Stock Exchange under the ticker symbol HRAA and is sub-advised by Resolve Asset Management. HRAA is an alternative fund whose investment objective is to seek long-term capital appreciation by investing, directly or indirectly, in major global asset classes, including, but not limited to, equity indices, fixed income indices, interest rates, commodities, and currencies. HRAA gains exposure to these asset classes by investing in derivative instruments that may include future contracts and forward agreements and securities. HRAA will take long or short positions, using up to a maximum of 3 times leverage in asset classes such as equity indices and fixed income asset classes, commodities, currencies, volatility indices, and other alternative asset classes. To learn more about this, please visit www.horizonsetfs.com/HRAA to read about the ETF's investment objectives and important disclaimers about the risks associated with an investment in the ETF.